Hello, it's Darryl Gobbett, and we're following on from some of the issues we've been talking about with term deposit rates and wholesale money market rates and where we expect interest rates to go over the next year or so and the impact that's going to have on investors. We sort of ended off the last video with this chart which shows the relationship between term deposit rates, fixed rate home loan rates, the rates at which banks can borrow, in other words the 3-year swap rate, and the rate at which the federal government is borrowing, so the 3-year bond rate. And as you can see in this chart, even though expectations are for the cash rate to fall further over the next sort of 12 to 18 months, we're already starting to see both the swap rate and the bond rate moving up quite considerably. Now, the next chart actually indicates some of the reasons why we expect the swap rates to actually move closer to the bond rate and why the term deposit rate and fixed rate home loan rates could well come down. And these two charts are from the Reserve Bank chart pack for December. And what they show is the relationship between the amount of deposits that the banks are raising in Australia. And as you can see there, the amount of deposits that the banks are raising as a share of their total balance sheet has actually risen quite significantly. And this was a major focus of the banks since about 2008 because of their concerns they might be cut out of wholesale lending markets overseas. And again, you might recall that was part of the background to the government providing the government guarantee back in September 2008. So the banks really were working hard to increase their retail deposit raising, and that's one of the reasons why term deposit rates actually went up relative to the swap rate and bond rates, because the banks were saying, we want to get on board these, in a sense, what they call the sticky wholesale deposits, and so we're prepared to pay more than what we would normally have done. And I think that situation where the banks are really striving hard for term deposits is starting to ease off. So I think we're going to be starting to see the term deposit rates moving down relative to the swap rate and the bond rates. And another chart on that same page sort of indicates what's been happening to the margin that the companies and the banks are paying over Commonwealth Government bond rates. So we've had both a significant fall in bond rates and also a considerable reduction in the spread that banks are having to pay. And I think both of those issues are going to be working in the bank's favour over the next couple of years. We're going to be seeing term deposit rates starting to move down, even if money market rates are actually moving up. And we can discuss some of those implications in a further video.